Good evening from New York. It's 5:52 p.m. on Friday, April 3rd, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is closed for the weekend, and what a session to digest. We got a downed American fighter jet over Iran, a jobs report that tripled expectations, and oil that's trading like it's 2008 again. Take us through the numbers.
Let's ground this immediately. The S&P 500 closed at 6581.56, up just 0.09%. The Nasdaq finished at 21,874.19, up 0.15. The Dow slipped 0.13 to 46,504.51. The Russell 2000 was the standout, up 0.72% at 25,330.37. The VIX at 23.9 tells you fear is elevated but not panicked. The 10-year yield sits at 4.31%, the 2-year at 3.61, giving us a positive 70 basis point spread, a normal curve. And the advanced decline ratio was remarkably strong, 414 to 99 advanced decline ratio, which tells you the average stock had a good day. It was the energy megacaps dragging the headline indices lower, while everything else rallied on that Hormuz hope.
Wait, energy stocks were among the biggest losers, with oil at 112?
That's the counterintuitive signal. 6 of the 10 biggest losers on the day were energy names. ExxonMobil fell 2.32%, Occidental dropped 2.54%, Phillips 66 lost 2.46%, APA Corporation fell 3.76%, and EQT was the biggest decliner at 3.83%. This is classic profit-taking after an extreme run. When oil surges nearly 12% in a single session, traders lock in gains on the names that have already repriced. But the sector scorecard confirms this is purely short-term rotation within energy. 86% of energy stocks are still above their 50-day moving average, 95% above their 200-day, and exactly 0% are near their lows. Zero. That is the most uniformly strong sector in the entire market.
So the jobs report, 178,000 versus an estimate of 59,000. That's a massive beat. What does it actually mean with all this noise?
It means less than it looks. Yes, the headline tripled expectations, but the 3-month average is only 68,000. February was revised down by 41,000. Labor force participation fell to 61.9%, the lowest since November 2021, and that's really what brought the unemployment rate down to 4.3%. 396,000 people left the labor force. Average hourly earnings decelerated to 3.5% year over year, the lowest since May 2021. So you have a top-line beat that removes any urgency for the Fed to cut, but underlying softness in participation and wage growth that prevents any hawkish pivot. According to CNBC, the CME Fed Watch tool shows virtually zero probability of action at the April 28 to 29 FOMC meeting and a 77.5% probability the Fed holds through year-end. The war-driven energy shock has effectively frozen monetary policy in place.
That's the key question every portfolio manager is asking this weekend. What does this mean for rates?
The 2-year at 3.61% is essentially pricing a Fed funds rate near that level through the remainder of the year. The 10-year at 4.31% with a 70 basis point spread tells you the bond market is pricing moderate growth but no recession. Here's the critical nuance on the Fed's reaction function. The Fed typically looks through energy shocks unless they feed into core inflation and inflation expectations become unanchored. Oil at 112 is a headline inflation event, but it takes 2 to 3 quarters of sustained elevated energy prices to contaminate core goods and services through second-order channels like transportation costs, food production, and shelter. So the Fed is stuck in a holding pattern. They can't cut because headline inflation is surging and already well above target, as CNBC reported, and they can't hike because labor force participation is collapsing and wage growth is decelerating. The transmission chain goes Hormuz stays closed, oil stays above 100, jet fuel doubles, which according to Airlines for America data it already has, with U.S. city jet fuel averaging $4.88 a gallon, airlines pass through costs with bag fee hikes and surcharges, Amazon slaps a 3.5% fuel surcharge on third-party sellers, those sellers raise prices, and now you've got energy-driven cost-push inflation contaminating core goods. That's the chain the Fed is watching, and it takes time.
So, who are the clear winners and losers from this environment?
Starting with cyclical winners, the technology sector dominated the gainers today with 7 of the top 10 movers. SBA Communications, the tower REIT, surged 19.11% on defensive rotation into rate-sensitive infrastructure. Ciena jumped 11.67% on fiber and networking demand tied to the AI build-out. Intel gained 9.38% after repurchasing Apollo's 49% stake in its Fab 34 Ireland plant for $14.2 billion. That's a strategic recapture of manufacturing capacity. SanDisk rose 9.25%, Micron 7.26%, and Seagate 7.08%, all riding a global memory chip shortage amplified by AI demand. CNBC reported that Chinese memory firm Changxin saw a 130% revenue surge, which confirms the global supply tightness lifting these names. And Corning gained 8.45% on optical fiber demand for AI data center build-out.
That memory and AI infrastructure rally feels disconnected from the war narrative. Is it?
It's actually connected at a deeper level. The war is accelerating defense spending, which drives semiconductor demand for advanced guidance systems and communications. Simultaneously, the AI CapEx cycle is creating its own structural demand. Microsoft just announced a $10 billion AI infrastructure investment in Japan with SoftBank, and Microsoft executive Judson Alfhoff said internally that they hit their March quarter Copilot sales targets. Microsoft itself closed at $373.50, up 1.72% on the day, with a 5-day return of 4.68%. But this stock is still down 20.85% year-to-date, trading well below both its 50-day at 403 and its 200-day at 755. The AI infrastructure spending is real, but the market hasn't rewarded the spenders yet. On the structural side, utilities are the defensive haven of this market. 80.65% of stocks above their 50-day moving average, 74.19% near their highs, and 0% near lows. That's extreme defensive crowding, consistent with a VIX near 24 and active war uncertainty. Now here's what the headlines are missing. Financial services has only 15.71% of stocks above the 50-day moving average in a sector worth $7.63 trillion. Consumer cyclical is even worse at 9.43% above the 50-day, with nearly 17% near their lows. That's $6.26 trillion in market cap getting quietly crushed by the combination of tariffs, oil-driven input cost inflation, and weakening consumer confidence. Industrials have only about 22% above their 50-day. These are massive sectors being hollowed out, while the headlines focus on the Magnificent Seven bounce.
Speaking of which, the Mag 7 had a strong week but a terrible year. What's the full picture?
NVDA closed at $177.40, up 3.03% on the day and 5.89% on the week, but down 6% year-to-date. It's below both its 50-day at 182 and flirting with its 200-day at 179. Alphabet closed at 295.79, up 1.75 on the day and an impressive 7.81 on the week, but still down 6% year-to-date, and Meta Platforms finished at 574.55, up 1.51 on the day and 9.27 on the week, the best 5-day performer of the group, but still down 11.6% year-to-date and trading far below its 50-day of 639. And Meta faces a new structural headwind. According to CNBC, jury verdicts last week in New Mexico and Los Angeles found Meta and Google liable in cases that circumvented Section 230 protections. This creates a new litigation risk specifically around their AI products, which is structurally significant as both companies bet their futures on AI-generated content. Tesla was the outlier, closing at 360.55, down 0.96% after missing first-quarter delivery expectations. It's down 17.69% year-to-date, below both its 50-day at 403 and its 200-day at 397. In a consumer cyclical sector where only 9% of stocks are above the 50-day, Tesla's chart is representative, not exceptional.
Let's talk about the tariff layer. 100% on imported drugs, metals, tariff-free calculations. How much does this compound the problem?
The pharmaceutical tariffs hit names without existing pricing deals with the administration. DaVita fell 3.08%. AbbVie dropped 2.42, though AbbVie already committed over $10 billion to domestic manufacturing. 13 companies have signed drug pricing deals and are exempt. The bigger structural issue is the metals tariff recalculation. Finished products containing more than 15% steel, aluminum, or copper now face a 25% tariff on the total product value, not just the metal content. The Committee for a Responsible Federal Budget estimates this raises an additional $70 billion in federal revenue over 10 years. For fertilizer names like CF Industries down 3.57% and Mosaic down 2.86%, this is a double hit from both metals tariff exposure on input costs and the broader commodity uncertainty from the war.
What's the risk case investors should be stress testing this weekend?
Our base case, which we assign a 55% probability, sees the S&P trading in a range of 6,400 to 6,700 next week, the 10-year between 4.20 and 4.45, and WTI between 105 and 120. The jobs print removes rate cut urgency, the Hormuz monitoring protocol provides a floor, and the strong advanced decline breadth suggests the average stock has found support. The Fed holds through year-end. The risk case, which we'd assign a 30% probability, is triggered if the Strait of Hormuz remains fully closed through April and Trump follows through on infrastructure strikes against Iranian power plants and bridges. In that scenario, Brent spot could push above 150, WTI could hit 130 or higher, and the S&P could fall to 6,100. The 10-year would likely push toward 4.55 as inflation expectations spike. The causal chain is clear. Sustained $130 oil compresses airline margins. United is already hiking bag fees $10, feeds through Amazon's 3.5% fulfillment surcharge to consumer goods prices, forces Maersk and container lines to implement emergency bunker fuel surcharges that have already pushed ocean freight rates up more than 20%, which hits food and fertilizer costs through firms like CF and Mosaic, and ultimately pushes headline CPI high enough that the Fed can't even discuss cuts. That eliminates the single most powerful equity catalyst, the possibility of easier money, and forces defensive de-risking across portfolios. The upside case, about a 15% probability, is the Iran-Oman-Hormuz monitoring protocol materializing into an actual partial reopening of tanker traffic within days, combined with a ceasefire framework. That could collapse WTI back toward $85 to $90, unwind the energy inflation premium, reopen the door for second half 2026 Fed cuts, and trigger a violent short covering rally targeting 6,900 on the S&P, particularly in beaten-down consumer cyclical and tech names where positioning is extremely washed out. For positioning, highest conviction is energy producers. Maintain exposure immediately. They have the strongest breadth in the market. Secondary conviction is utilities as a structural defensive hedge. The 0% near lows reading makes it the cleanest safety trade. Tactically, if the VIX pulls back toward 20 on any ceasefire headlines, that's your opportunity to add put spreads on the NASDAQ as a hedge against the risk case. Avoid rate-sensitive consumer discretionary. The sector breadth is catastrophic. And avoid pharmaceutical names without existing administration pricing deals until the tariff implementation window closes.
When you step back, this is really about a wartime supply shock colliding with a labor market that's weaker than it looks, and a Fed that has no room to maneuver.
Oil at $112, a Brent spot at $141, a high since 2008, combined with pharmaceutical tariffs, metals tariff recalculations, and Section 230 litigation risk for big tech, creates a multi-front pressure environment where the only sectors with uniformly positive breadth are energy and utilities. The jobs beat provided a floor for sentiment, and the Hormuz diplomacy gave the market permission to rally into the weekend. But the advanced decline strength of 414 to 99 masks the fact that nearly 17% of consumer cyclical stocks are near their lows, and financial services breadth is gutted. The alternative view worth considering, if the Hormuz monitoring protocol is real and Iran is genuinely engaging through Oman, the oil premium could unwind faster than anyone expects. Jim Cramer noted that the S&P gained 3.4% and the Nasdaq 4.4% this holiday-shortened week, both snapping 5-week losing streaks. The market is telling you that beneath the war headlines, there's pent-up demand to buy the dip, and the Russell 2000's outperformance at 0.72% today suggests risk appetite hasn't disappeared. It's just migrated to smaller, more domestically oriented names. A ceasefire could trigger one of the fastest repricing rallies we've seen in years.
Give us the 3 takeaways to carry into the weekend.
First, the risk to watch. Brent spot at $141.36 is a 2008 level reading. If that persists for more than 2 weeks, the second-order inflation effects become unavoidable, and the Fed loses even the option of signaling future easing. Monitor the Hormuz protocol closely. That is the single most important variable for global asset prices right now. Second, the market insight. The divergence between energy sector breadth, 86% above the 50-day, 0% near lows, and consumer cyclical breadth at 9% above the 50-day is the widest cross-sector gap I can find in this data. That's not just a rotation, that's the market pricing a structural regime shift towards supply-constrained commodity economics. Third, the positioning idea. Intel's $14.2 billion repurchase of full control over its Ireland fabrication plant, driving a 9.38% single-day move, is the kind of strategic reshoring action that benefits from every policy vector in play: tariffs, national security, AI demand. Semiconductor names with domestic manufacturing leverage are where the tariff and defense spending tailwinds converge, and that theme has legs regardless of the war's outcome.